Hi guys, welcome to the weekend analysis for the 26th of October 2019. Now, as always, before I get into this, please do just pause the video, make sure you're comfortable with this. There's no investment advice here, this is just technical analysis insight. I'm registered with the CMT Association. Technical analysis is what I'm widely known for. These weekend analysis videos are incredibly popular. So hopefully you just get a little bit of insight and hopefully this just helps you out in some way. A lot of you, judging by the emails and the messages that I'm receiving at the moment, feel like there's a consistently huge knockout blow getting delivered day after day to you, and hopefully my YouTube channel will help you out. So in the bottom right hand corner there should be a little subscribe button, so feel free to kind of follow along with our technical insight. Now, I've had a big reaction to the big announcement I made on Tuesday. For those of you that are perhaps not aware, I have just announced the honeystocks.com premium charting research, trade ideas, whatever you want to call it. That goes live on the 1st of November, and there's been a huge reaction to that. So thank you very much for everybody that's obviously requested this over the last couple of years. Again, hopefully this explains all, everything that we're working towards, and ultimately serve everybody a little bit better through the eyes of technical analysis. So rather than ramble on, let's just get here, what you're here for, get to what you're here for. So the first thing I want to touch on is the relative comparison chart. Now, again, this looks like a lot of bright, shiny colours, but it actually tells us a little bit of a story. What we can see here is the S&P 500, which is obviously the benchmark for the market. In order to generate better annual returns than the overall market, you really need to identify where the strength is in the market. Now, hopefully, we can see that over the last 12 months, the semiconductor space has been an area that is recently particularly starting to massively outperform the market. We've had real estate, gold, tech, payment processing and utilities. They've all been areas of strength in the past also. But in order to really generate the consistency, pick the best decisions, you also need to pay attention to where the money is flowing into, where the money is moving to. And this is just one of the tools that I like to use to really facilitate some, educated decisions in the market, and that's really what I'm looking for. So let's touch on the S&P 500, and I think there's a little bit of a joke at the moment with my client group at the moment. I think we're all expecting a tweet over the weekend at some point. It's either going to blast the market off on a rocket ship on Monday, or a well-placed tweet at resistance is something that we've just come to accept over the last 12 months. But we are very, very close to breaking out in the S&P 500. That's not a bearish move for the market. This was a chart that I put out to social media during the week. It made the financial Twitter chart report chart of the day. And I think this tells a story, because I think if we break out, I think if the mid caps break out, I think that will be the catalyst for the S&P 500 to go on and push forward. And I really do think that we can then start to aggressively get long with some of the stocks that we've obviously identified. We also need to accept that the Global 100 Index ETF, which is a basket of stocks that is made up of biggest companies all over the world. So we've got the biggest US stocks, the biggest Japanese, biggest European, British, they're all in here. And given that we are breaking out above a logical level of resistance, again, that's not a bearish move for the overall market. So let's dive into the individual stocks. Now, as always, I'm going to be highlighting a lot of the stocks that I've been requested to talk about over the last 7 days. I've also got a few charts that I want to just throw in there that I've provided my clients this week that you might find some use for over the next week or two. But as we can see, Apple, I highlighted this one the last 2 weeks, but Apple has broken out. I think it does have the look of being a little bit overextended at the moment. I would expect a little bit of a pullback here. There's obviously earnings coming up. That's something to be aware of. But I think what we're looking at here, I wouldn't be jumping into Apple at the moment. I think you need to be very mindful of, overextension, certainly momentum indicators and so forth. And I think at the moment, we could reasonably expect a little bit of a pullback given the huge run that Apple has had over the last few weeks. Twilio, I highlighted this one on Tuesday with my cloud and software stock analysis, and the level that I was concerned about looks like it's held. Now, that wouldn't be the signal for me to go jumping in and buying into the dip on Twilio. I think a little bit of patience would be required. The concern for me on Twilio would be that we've got a very clearly defined descending trend line, and I would be looking for that level to break in order to suppose have the confidence that the stock is going to move higher, because what we can see sometimes is we could get another rejection and then another fall away. But I think it's not an area that I would want to be playing in. I think there are much easier picks out there at the moment. Nike, I've been asked about a lot this week because of the declines that we've had. I think it's very logical. It's something you don't need to make it more complicated than it is when it comes to technical analysis. And for me, this chart makes a lot of sense. I think we just say we're bullish above this level and bearish below it. That's it. Now, I think you can still logically have a $100 upside target, but I think for me, all bets would be off if we break below that level down there. We've also got Nvidia that's breaking out. This is a chart that's been talked about amongst my clients in my community, etc. And that chart just makes a lot of sense. This is a chart that I think everybody's been waiting on, and it seems to be off and running. And when we consider that semiconductors are obviously outperforming the market at the moment, it's an area of strength. I think even if Nvidia might be a bit too expensive for you, for example, you can certainly look to other areas of the market and other areas of that individual sector. Canopy Growth is looking possibly quite interesting. Now, I think the first thing to say is I'm not big on the weed stocks at all. However, as it was requested, here's my analysis. I think we've got a very clear descending channel, but what we do have here is bullish divergence. Now, I think if we get a break above this logical area of resistance, I think that might be a catalyst for some buying action into that individual stock. So I think CGC, if you're out there at the moment and you're maybe looking to take a position in there, I've seen worse setups, and technically it's starting to look a little bit appealing. Visa again is doing as expected. I think we've still got a very logical upside target here around 185, 184 to 185. I don't see anything about the chart for those of you that have been asking. Zendesk, again, coming down to the cloud software stocks, etc. I think for those of you that don't know, I think below this level it's very, very much a bearish type scenario. We've got a declining 20-day simple moving average, and I think if you're out there in Zendesk at the moment and you're maybe short the stock, I think you've got a lower target there of around $50. Now, I will absolutely reconsider that thesis if we get a break back above this level. And I think just to follow on from what I was saying on Tuesday with my tech and software analysis, I don't have any affinity to any stock. I very much take the view that I am dating the stocks, I'm never marrying. And I think it's always a very dangerous game when you get married to stocks. Maybe you've got a fundamental outlook. Maybe you keep going back and you keep trading the same stock. That's something that I observe quite a lot, especially with the guys that I talk to and obviously work with as well. But I think with Zendesk, the chart at the moment is bearish. I apologise for any of you that are bullish on the stock or maybe hold the stock, and maybe you're under a lot of stress at the moment with a lot of these tech and cloud stocks. I obviously can't do anything about that, but if you're out there, I think there is a logical $50 potential downside there before things get a little bit better. United Rentals is a chart that my clients got an alert for on this, and it's off and running now. For URI, I think for me, if you're out there and maybe you're looking for a new entry and maybe you've missed this entry, I think that level probably makes a lot of sense. I would be looking at something along the lines of that, and I think by maybe moving in there, I think you've probably got a logical upside. Yeah, it's around 20%. So I think that's something to maybe bear in mind with URI. And again, this probably represents a bit of a logical shorter term profit target if you're more shorter term inclined. TJX, I think the pullback is perhaps offering a little bit of an opportunity here. Stocks don't go up in a straight line, unfortunately. I think our job would be much easier if it did. But perhaps TJX, I think given that we've got a breakout here, it's taken a little bit of a breather. If we think about stocks, more as a marathon and not a sprint. As you move along your marathon, you're going to want to take a glass of water and chill out for a little while, and that's kind of what's happening there. I think with TJX, I don't think the trend is necessarily over, but again, we must always ask ourselves, what if we're wrong, and what are the danger zones on the chart? And I think the danger zone for me would just simply be below this level. I think it's that logical with this chart, and bullish above this level, not so bullish below it. AMD is fast approaching a logical profit target. Now, I know many of you out there are obviously hoping for this longer term breakout. This resistance goes back 12 months. Yes, I've got an attachment to the stock because of this huge move to the upside, but I think what you must always understand is that stocks become less appealing after a while. And yeah, I understand that there's been a bit of a dip here, and some of you will have bought in and doing very well at the moment. But the technical game tells us that this is likely to be a profit target for a lot of traders. And I think there probably has to be some sort of news catalyst or something to kind of take this out and above this 12-month resistance level. Procter & Gamble, this is a chart that a couple of my guys have been doing very well on recently. We got a bounce off support just before earnings, just in time, and lo and behold, the earnings gap up, and we're now hovering around resistance. I think, given that we've had positive earnings, it's not a chart that I would expect to fall away, but I think if you are out there and maybe you're waiting patiently for this breakout, I think that would make a lot of sense. SPLK is now starting to have the look of a favourable chart pattern. Now, I know that I highlighted this the other day and I just said, look, this is a level that you need to be considering. We're obviously bullish above this level, below it again, not so much. We've got the support come in there, which is obviously good. But I think for those of you that are maybe looking for a new entry on this, I wouldn't go jumping in at the moment. I'd be waiting to see what happens with this 200 simple moving average. And I do think that you've got a logical upside target there. That's really how I see SPLK at the moment. AYX, Again, for those of you that don't know, I've been bearish, I suppose, on this breakdown here. Again, I highlighted this one last week and just said, look guys, if this level breaks, I think this is a logical target to aim for. We've kind of entered that target zone. This is a concern though, because it looks like we may have had a 200 simple moving average rejection. If that is the case, then you would expect further declines. However, just to kind of give us a little bit of an issue, we've obviously had a huge intraday bounce on Friday there. So I think for me at the moment, I wouldn't be going in and buying AYX. I think technically it doesn't make a lot of sense. Possibly fundamentally, I think you fundamental guys will know more than I do. But that's something that I would be observing at the moment. I think in order for me to move in on this, I would probably be waiting for this level here to break, and that's around 110. So that's kind of how I see AYX at the moment. Very similar Octa, logical support level has held. We're in a range at the moment. We've got a logical upside target there around 120. And I think if we get a breakout above that level, I think you can probably look to maybe go in, or maybe you've bought this dip and maybe you want to compound and add to a winning position, which is always something that I would advocate rather than adding to a losing position, which is also known as dollar cost averaging down, which for me is a ridiculous concept. But you know, Warren Buffett did it, so everybody else can do it apparently. But it's that's actually how I see Octa. Disney, I think with Disney, this is the concern: 50-day simple moving average rejection. I think we've got a chart pattern there would look appealing. I think if we get a breakout with follow through, I think it needs to clear this level here. But we can see that the 50 simple moving average is starting to turn upwards. But again, understand where the blind spot is on the chart, guys. I think when key support levels get broken, that's where you start to find the distress and obviously the selling action coming in. Caterpillar was a chart that I sent out to my guys on Wednesday, and lo and behold, off and running, it's moving. And you know, you would expect a little bit of follow through here. I think a lot of it will depend. I think there's obviously a big exposure with China with Caterpillar, so that'll be interesting. But I think at the moment we just have to treat it as a breakout and you know, manage the trade thereafter. INXN, breakout, retest, off it goes. Textbook price action. And I think if you are out there and you're looking for a chart to maybe allocate some risk, I would suggest that you would need to find an optimal entry. I don't know if this is one that you would necessarily want to piggyback onto at this exact moment in time. If you've missed this breakout and you've missed this retest, then you are probably chasing at this point. And you know, for me, I like the trades to come to me. I don't like chasing. So INXN I think makes a lot of sense. Comcast, again, this is a chart that I've talked about with my guys. We've had what I call the earnings discount, and yeah, this is a chart that a couple of my guys have acted on this week, and lo and behold, support, and then it's off and running. So Comcast, very, very appealing at the moment. And I'm just going to maybe touch on Applied Materials. A lot of you will be aware that this is an alert that I sent out to my client group, I think around 2 weeks ago. And the thesis that I had was absolutely, you know, we've got a favourable chart pattern here. We're waiting for this breakout. Now, we kind of chopped about sideways. And the one thing that I understand is that with certain stocks, they have a direct correlation with other stocks. And with Applied Materials, there's a very clear direct correlation with Lam Research, who were reporting earnings. Now, if Lam Research reported earnings and that earnings was negative, that would have had a direct impact on Applied Materials. So I made the decision to cut my position prior to Lam Research earnings. Lo and behold, Lam Research reported knockout earnings, and the thing, I think, gapped up, let's say 8 or 9, 10% or something. And Applied Materials again gapped up 8, 9, 10%. Now, what I like to do under scenarios such as that is when I get a little bit frustrated with certainly my discipline and my rule set, which serves me very, very well. What I like to do is when I'm frustrated, I like to just take a step back from the market and remove myself for 24 hours, because I will have a natural tendency to, I don't think revenge trade is the words to use here, but definitely I'm more active in looking for, I suppose, charts to get in on. And again, that brings an inherent issue, because then, to touch on what I talked about before, where you start to chase trades, and as soon as you start to chase, you start to make impulsive decisions. When you make impulsive decisions, you make incorrect decisions. When you make incorrect decisions, that translates to losses, and that's not something I like to just nip it in the bud, right at the source, and that's what I did. And Applied Materials, the thesis has absolutely been proven correct, but I think the issue is possibly my own discipline worked against me there. But I'm perfectly okay with that, because what you have to understand is that you can only make the decisions at any given moment in time. You can never have the what ifs and work on hindsight. I think we would all be the world's greatest traders if we worked on hindsight, but hopefully there's some learning in that for you. And that brings us full circle. So if you have enjoyed this, down below this video there is a link. If you want to register your details and you're interested in finding out a little bit more about what it is that we're doing at honeystocks.com over the next 12 months, then just sign up, register your details, and we'll get in touch with you. But there's a lot there, and if you are maybe coming across my work for the first time, I'm Sam, and like I said before, I'm registered with the CMT Association. I run honeystocks.com, super well-known technical analysts, and we obviously have mentoring programs, etc. We've obviously just implemented our charting research, which we are opening up to the world for the first time in 2 years. Normally our research has been exclusively for our clients, but we are now opening up an annual membership. We're not interested in monthly subscriptions. We don't do day trading. We are very much mid-term traders, investors, whatever you want to call us, but we do provide technical insight, and that's what we're really well known for. So if you're maybe trying to fit, trading, investing around a career or a business, maybe you want to move away from day trading, maybe you want better consistency, maybe you want to learn and not just follow others and hunt around social media all the time, we can probably help you in some way. The good thing about what we do at honeystocks.com is we log every single trade idea that we post to our client community, and you can go onto our website and check all that out. I'm not saying that you will achieve 1400% returns in a year. You absolutely will not. You can only allocate a certain amount of risk to any one position. But if you're out there, maybe you're learning from losses or hunting around YouTube for all the free content that you can get a hold of, maybe you feel like Wall Street is just swallowing you into a big black hole, again, we can probably do something to help you. So very, very simple, guys. It's, do you want to consider a new way, or are you going to carry on doing it the old way? It's really that simple. If you want to learn a new way, like I said before, there's a link below. Just register your details and we will get in touch with you in the next 24, 48 hours. But thank you very, very much for watching, and hopefully you've got a bit of insight from this. Thank you very much.